Okay, Josh. Well, thank you very much. I appreciate that warm introduction. I want to thank everyone for being here. And I think it's been probably about over 10 years now I've been full-time trading. But I started with actually position trading and then got into the day trading like so many of us do. Before I get into this presentation, let me just thank Trader Kingdom for this opportunity and the commitment to traders for free education. I'll be using NinjaTrader charts and kinetic data. Now remember, we're all adults here. Trading financial instruments using contracts, stocks, or options is extremely risky. Only trade with money you can afford to lose. Past results do not guarantee future results. Please consult a licensed professional prior to trading using real money. Paper trade to learn any new concepts. Paper trade regardless of your level of expertise. Now, as Josh mentioned, I've been trading over 25 years. I started this newsletter in 2008, but in 2013, folks wanted me to do a nightly video format. People don't want to read as much as they used to, apparently. And so then I got into total immersion boot camps, okay? And it was really geared to position traders with a little bit of discussion on day trading. However, the day trading is what everyone's after. So last year I introduced a total immersion day trading course, and I'm telling you, it's got everything in it, from soup to nuts. This is me, your instructor. This is my trading room, lovely Southwest Florida. And basically, if you'll let me have about 1 minute to tell you about what I do, and we'll get into this presentation. My newsletter wants you to become your own expert. I call trades in advance. You watch them unfold, practicing on paper, okay? So the last trade, I think, for position trade was a quick pop counter trend trade in lean hogs. And certainly it went down to our target exactly, bing, bada boom, bada boom, done. We stalked a beautiful sugar trade, wonderful sugar trade with a short. So, we're all over the stuff. And we look at the charts every single night, Monday through Thursday. On the weekend, I do a review of the weekly charts. It just keeps everyone aware of the big picture, okay? We're always working from the right edge of the chart. Now, Josh mentioned I've got this rooster call. I write this up every morning. It's a quick read, but it takes me about an hour and a half to do it because I look at what's going on in the overnight markets. I look at what's going on in the news. And it's primarily to help the day trader, but it's good for all traders, actually. It's a trader's perspective, not simply the news, but a trader's perspective. So you can, if you're interested in this, please go to hitthemarktrading.com. You do traders, it will talk about day trading, but it's also for position traders. Hey, we're doing this next week, okay? It's total intensive 6 hours. Big time helpful. So I would suggest that you go again to the website and learn more about it. I got detailed information on it. If you are a day trader, let's have an understanding. This is the hardest type of trading you can ever approach. So you really need to leave complex trading behind and focus on simplifying. The next class is February 23rd, 24, 25. In addition to the class, I think it's around 12 days. that you can just join us Tuesday, Wednesday, and Thursday. 2 hours only. Hey, I'm over the days of thinking I got to sit there all day. And you'll just watch us implement what you've been taught. Let's get started for the presentation. And Don, thank you. I appreciate that. Says Rooster Call is very helpful. Thank you for your time. You're most welcome. When I get into this presentation is about education. So I'm not going to be constantly trying to beat you up to buy anything. Forget that. I get so involved in the presentation. If you have a question, I'm not ignoring you, but I would rather address the questions at the end. If you're going to write a question, make sure that it's something that when I go back and look at it, I know what you're talking about. I want this to be a really good presentation for you. Now, what is momentum trading? Momentum trading is the art of spotting a market, ready to move, selecting a trade, entering the trade with confidence, and utilizing predetermined exit points. That deal in Lean Hogs was just a 2-day trade. It did exactly what we thought it was going to do. Okay? Perfect. And today's trading. I mean, yesterday was fantastic. Today was fantastic. Okay? Momentum trading builds off a firm understanding of support and resistance along with known areas price is attracted toward moving. Nowhere in here am I saying, hey, we've got to have a dozen indicators. Gee, we got to know what the dome is doing. My goodness, we got to know what the market profile is. Gosh, we got to know, is it raining or is it sunny outside? You know, really. If you're going to day trade, and that's what I'm focusing on in this session today, you've got to learn how to react. You can't be waiting for everything. Now, what is momentum trading? Trading directionally up or down, riding the price wave rather than reacting to what might happen. We let price prove what it wants to do. Usually this is accompanied by a price oscillator used for intraday or short-term trading holding over a few days or weeks. Now, to determine the trend, intraday uses daily chart for the big picture, use short-term chart for tactical entries, and as a general rule, the more volatile the market, the smaller the time frame. If your market is quiet, then you need to open up that time frame. We know that markets move in 3 directions, up, down, and sideways. If the market is sideways, we're greatly challenged unless the range is large. Now, even in day trading, we get in sideways markets. Hey, we got a little tool to help us on that. That's it. You know, just we note where the sideways market is, if it's a tight range, and then we just say, price, when you are ready, then we'll get ready. But apparently, you're in a tight range, and we're not going to get chopped up. It's very simple. Easier said than done when you don't know what we do. We box that price action. Now, to identify trend, you want to bracket price with trend lines. Daily chart and intraday chart for day traders. And just understand price is going to bang back and forth between the trend lines. So here's an example of the daily chart. Daily Russell 2000. I'll use the Russell 2000 as example. And so you can see immediately, well, hey, price is going down. That's right. It was obviously, let me get my pointer. It was obviously an event breaking this line. So if you saw the daily chart doing this, guess what? It's a forecaster. Chances are the day trading is going to be pretty good. What happened here? Broke another line. Chances are, if we break that line, the day trading is going to be pretty good. Okay? So you learn these things. Now, This is an old chart, but I just want to show you that I call this area the killing field. And the reason I call it that is because this thing can run up $300-400 in less than a minute and then give it back. It's very, very difficult. Unless you have experience trading gaps, I'm going to suggest that you turn conservative. Remember, the fact that you're day trading to begin with tells me you are an aggressive trader. So the market tends to have a semblance of where it wants to go after 9:45. I just wanted to throw that out there to you. Now here's today's chart. So what I talk about drawing your lines, just for reference, this is about 3 o'clock in the morning. Okay, we can draw this. We can just touch in here and here and here. Okay, I see that. Obviously, it will be meaningful when we break that line. Okay, I know that. You could have a drawn line here, right? And you know, it's before the market opens, you just are drawing this line saying, okay, well, this is interesting. And if you look at this blue line here and this blue line here, it's a classic wedge, right? The wedge is where there's a pressure building up. Bang, 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 bang. It's got to explode. And if you want to, you can extend these lines. So let's just look at what happened. Wow, extending this line was certainly beneficial, right? I'm telling you, these lines are amazing. So when it finally broke through, guess what? It was an event for the day trader. Don't worry about the indicator. I'll get into that. Support and resistance is huge in momentum trading. Absolutely huge. We learn to identify probable areas price wants to touch over and over again. You've got to understand the algorithmic trading programs, they trade over 70% of the market. This is not a lot of people looking at indicators and everybody deciding where they're taking the market. This is a machine you are going up against. The machines have to have benchmarks, and that is support and resistance. After the machine has taken off, then it shows up. Oh my goodness, look at the market profile. I guess they're going in a new direction. And I don't have anything against market profile. I just think that in day trading, you need to get as close to the action as possible, especially if you are, like me, a visual trader. Now, use of an oscillator. Oscillators derive their power from price movement. So for this reason, you really need to understand how to read price action at support and resistance areas. The oscillator then provides a trigger point for entry. So this is what most traders look like when they're trying to figure out, hey, which oscillator should I use, right? Those are my chickens. They're all adults now. But that's a general idea. It's like, well, you know, should I use it or not? So in the beginning, for position trading, which means I'm looking at charts in the evening, you have the luxury of relaxed, get some music playing in the background, got something to drink, looking at the charts, and you can put everything on there. I used to use slow stochastics, MACD, Williams percent R, and RSI. I probably had Bollinger Bands, and it's quite easy. Everything lines up. Take your trade. Well, at present, after years of studying this thing, I just use one indicator. My desire to simplify. It's the Commodity Channel Index, also called the CCI. This is very important for you to understand. In a strong momentum market, all price oscillators work. And I mean to tell you, everything works. So after we've had a wide range day, this is when the people selling their systems get out there and beat the band and talk about how wonderful their program worked. Well, guess what? Everything worked. In a tight range market, all price oscillators are going to lose their predictive value. All of them. You don't hear about those guys who are selling when we go through this period of really, really tight markets. Okay? And we are going to get back into tight markets, I guarantee. Several markets looking for momentum. Furthermore, you really need to work with an oscillator that speaks to you. Okay? What is the CCI? Well, the CCI is the Commodity Channel Index, a price oscillator created by Donald Lambert. I've met Mr. Lambert. In a moving market, the CCI is shown to lead price. Now, please do not take my word for this. You know, in this business, it's all about trust but verify. Just verify everything in trading, whatever somebody tells you. So, John Murphy's book, Technical Analysis of the Financial Markets, this is required reading for people that want to become a, chartered market technician, something like that. Required reading. Now, his book covers a lot of different indicators, and he spends maybe one page, almost a page, on the CCI. Now, here's all I want you to see here. Notice that the CCI turns before prices at each top and bottom. Okay? Got that? That's big. Okay? That's big. Maybe this would be better. Yeah. This is big. Now the default length is 20 days. That means when you turn on your chart package and you start using CCI, it will automatically be set to a 20 period. If you're using daily charts, it will be set to 20 days. If you're using weekly charts, the CCI will be set to 20 weeks. If you're using intraday charts, if you're using, let's say, a 5-minute chart or a 15-minute chart or a 512 tick chart, whatever, it will be set to, we're going to change this, and I'll tell you about that later, but it will be set to the increments of whatever you use. So here's what this man is talking about. The CCI starts turning, okay, we're turning down, and price goes down. It predicts it's going down. Here we go up, and guess what? Price went up. Okay? Price came down, and price goes up, and guess what? Price goes up. Okay? Now this is interesting. We go down here, but price is still going higher. And the explanation is that whatever gets you in early can have a tendency to take you out early. Well, obviously, we use other things than just the CCI. We use a couple filters. All right. The CCI is a price oscillator. All you need to know is that we are comparing price with a simple moving average over a selected time span. Mr. Lambert suggested 20 days, or let's just say a 20 period. Others have modified Lambert's suggestion for intraday using 14, using 6, using 5. I've gotten flyers in the mail from people selling systems, and they'll use 30, they'll use, I've seen all over the board. Okay? How do you calculate this? You don't worry about it. Most software platforms have it all automated. All you do is input the period, the time period. That's it. I will show you the calculation, but if I look at this for too long, my eyes will get real glassy-eyed. So it's just, for the engineering types or the doctors in the audience or the airline pilots, I know you want to look at this, and I give it to you. All I'd like you to know as a visual trader is that the CCI is plotted on histogram. I'll show you that. The zero line on the histogram represents major support and resistance. The 100 and 150 line, or minus 100 and minus 150 line, represent minor support and resistance. So let's just look at this. A chart. So this is the numbers I'm talking about right here, okay? These are the numbers. And this is the zero line right here, okay? And then on the bottom, you got more numbers. So as we go down, minus 100 is minor support and resistance, meaning if we break through, then it's showing you, hey, there's some strong momentum down there. Same thing for 150. And typically, minus 200 is where you'll start seeing the momentum indicator will just kind of shoot up there, and then it's like, okay, we've kind of gone as strong as we can, and then it'll kind of back down. But the big line I want you to focus on is right here, okay? The 150 and the minus 150. These are the most important. So on the zero line, the rule is if you are 5 to 6 bars above that zero line, we are saying we have an upward bias according to CCI. So you're going to see price in a moment, but the thing is, all this right here, without looking at the price, I can see price was going up because of all of this action above the zero line, okay? Now, all of a sudden, we go down. As soon as we print that 5 to 6 bars below, then I know, without looking at price, most likely price is down, because remember, the CCI is leading this thing down. Okay? Now, the reason I want you to look at the 150 line, okay, is because this is where we start drawing our diagonal trend line break. It's very powerful, auspicious. And the question is, if you cannot draw a diagonal trend line, do you really want to take the trade if you can't draw it? So I will get into the price action later. Let's just focus on the indicator for those of you who have never seen it. This is what I'm talking about. We're going to draw it. The black line, this is 150, remember, okay? Let me remind you. Oh, there it is right here. Right here. So that's 150. This is minus 150, okay? So just remember, we got to be at least above this line. And if it is, great, we draw it. We want to get a touch, okay? So we want to touch. And then breaking this is when we say, okay, we got a diagonal trend line break. Let's look over here. There was really no touch. We just ran it all the way down. There wasn't any kind of a bump. Just so run it all the way along the side of it. Okay, so here's the bump here. Here's another one. It's hard to see because this actually went down a little bit, and so that it made a bump. I think that's a trade we took. This you would automatically have something like this probably first. Whoops. Something like that. Okay. My goodness. So here's today's trading. Now, it's easy to look at this as a static chart, end of day, whatever. We're looking at this and saying, oh my goodness, well, you should have just bought on, sold here, and you should have just let this thing run, and my gosh, you should have made a lot of money. Well, that's not reality. That's not reality, okay? I always say that if people want to take advantage of these long runs, you've got to use a large stop, and you need to have some method of trailing it. Otherwise, the day trader many times feels like they're not sitting at the banquet table. They are underneath the banquet table eating crumbs, and they are quite happy. What is it they say? An elephant gets mighty big eating peanuts. So a lot of the day trading is in and out and in and out. Let's look at this diagonal trend line break. So here we've got, oh, by the way, this is the start time, 9:45. And this is the end time, 11:30. Obviously, you can trade all day if you want. Here we've got our line drawn. We got a touch. There's a touch here. Okay. Didn't matter if I'd have tried to touch set two. Both worked. But the main thing is you draw that line. And according to the way we trade this, it means breaking this. If CCI comes and breaks this line, then we ought to see price go up, right? Boom. Absolutely. Diagonal trend line break here. What happened? Price went up. Boom. Absolutely. What happened here? Diagonal trend line break. There's our touch. This is important. And it's hard for you to see, but there was a touch here. The line actually covers it up. And what happened? Up we go. Okay. Now, all of a sudden, you've got a little changing of the gears. You've printed 5 to 6 bars below the zero line, and when you keep going, now you're looking for a reason to go short, right? So yeah, you could have done this right here. And that was probably somewhere around here. That would have worked. I think this one I marked is one we took. And here's another one. And here. Okay. And here. The key thing is I'm drawing from minus 150 or greater. Get it? Simple, but it requires practice. You cannot expect to just jump in the market tomorrow like you know what you're doing. I'm telling you, I spent a lot of time on this stuff to prove to my brain that it actually worked. Now, for intraday, this is important. We're not using 20. Faster time, faster market. We have to shorten up the indicator. We're going to use 14. Okay? We're going to use 14 for all time periods below 60 minutes. 14 for day trading. We're going to use smaller time frames and moving markets with a good range. Now, I like to use a 10 range bar chart for most things. The NQ is so, it can move in such a hurry. The NQ, I bump it up to 25, okay? Crude, I've traded the 10, but if you get a day where it's choppy, you'll get wiped out. So if you want to just smooth out the action, use 20. In other words, for the range bar chart, the bar's not going to print until $200 have gone by, right? 20 ticks. Now, extensive use of floor pivots. I don't have time to review floor pivots today, but extensive use of floor pivots. We trade the rush hour instead of all day. Obviously, you can trade all day if you'd like, but if you have not made it in the morning, chances are your mind is just not right, or the market's not right, and it's probably a good clue to just take the rest of the day off. Remember, you don't have anybody to tap you on the shoulder and say, maybe you should just come back tomorrow. So people will sit there and say, well, I can keep trading. Something's got to come up. No, something does not have to come up. So learn to become an expert in the rush hour, the morning. And the idea is keep your brain fresh instead of bored. Now, people say, they get into trading because they, want to make some money and they want to be their own boss and blah, blah, blah. Well, I think they also want to enjoy life a little bit better. That's why I'm big on just trading the morning only. There's a world out there. Now let's talk about today's live trading. The start line is 9:45. The end line is 11:30. Now, I'll tell you right now, this market was extremely fast in the morning. It was very, very fast. And then, of course, you had Janet Yellen, right, giving testimony to the Senate. So a lot of people will say, you know what, I don't want to trade when that stuff's going on. No problem. If you don't want to trade, don't trade. So this is a diagonal trendline break. The move had jacked up over here. Okay, like over 300 bucks, very, very, very fast. Then it just jerked right back down. So we elected to just be a little bit more cautious. There's never anything wrong with being cautious. It is not a sin to miss a trade. And then what we did was we put another requirement on price. We said, you know what, if you're serious, we'll wait till you get over this. Now this is just because we decided to be more cautious on purpose because of the Yellen testimony. And because the market had fallen, ES was down like over 2% in the overnight. So it was a very rough morning. These guys were not sure what they wanted to do. Suddenly, boom, they took it off. So we got in as price proved it moves itself over this line. We don't do that all the time, but it was cautious today. And of course, as soon as we get in, it goes against us. So, we took a small loss. Over here, if we had just followed the signal, it's easy after the fact to say, well, you should have got in. Why didn't you get in? Okay, well, you get in the trenches with us and you'll see why. Okay, the other thing is we had a diagonal trendline break here. This was about in, 5 seconds was $100. $300 was less than 1 minute. So we decided to go to the ES. It was just really moving fast. Okay. Next thing I know, shoot, $300 up in the ES. And then come back over here, and this is a trade we took now. This is a classic diagonal trendline break here, right here. Now I'm talking about this one, this guy right here. Okay. And it fit the bill, but it wasn't ready because it was a fast market. No problem. We got a small loss there. We had another opportunity. Boom, we took it. Why? Because we could not print above the zero line right? Hardly at all before we came right back down. This was a beautiful trade. We got in another trade right here. I got X means it was a loss. Y means it was wonderful. Another trade. So yeah, and then we rode this down through it going up against us. We rode it down further. Here's another trade we took, okay? It's classic, and down we go. Here's another trade we took. Now, this one, right here, it says we're going to go down, and it was right about right here. It went up a little bit, and listen, we just said, you know what? Exit out. Because it was just being, it was too much of this too much of this going on, okay? And we know that markets are moving with crude. They're not moving like they normally would. In other words, of their own free will. These markets are moving, especially Russell 2000, with crude oil. So by golly, when we see crude suddenly start turning down, we get worried. Okay, no problem. We saw this, okay. Then it looks like price doesn't know what it wants to do right here. Okay, look at this business. So, we just say, well, price, if you don't know what you're going to do, we don't know what you're going to do. So we're just going to wait. When you decide you know what you're going to do, we're going to join you. And that opportunity came right here. Okay, right here. So boom, we got in this. Immediately went against us a little bit. That's fine. That's fine. And we rode this thing down. All of a sudden, here's one opportunity. Here's another one. Now, over here, we took this down. Hey, it's classic. It came up and it bit us. Okay, so boom, we got out like curses. And then over here, diagonal trend line break, and we caught this one. So the bottom line is there is no system out there that is going to be 100%. I wish it was. Okay, I really did. If it was 100%, I would not be, talking about how rough the market was. What I can tell you is, in our live trading, we've won every day this week. You need to figure out what your win percentages are, but I can tell you, based on what the trades we are taking in the live trading room, we are at 70%. Okay, obviously, you are not going to get that if you don't. It's a wonderful win rate. Now, the thing about day trading is you've got to accept that you take the signal when the signal is provided. And that means you are going to have losses. You have to embrace your losses as the price of admission. Or you need to stop the day trading. Okay? Now, I go for some larger targets. Sometimes it'll go $100 or 9 ticks and then whip right around and kick me. That's just part of it. You got to understand your instrument. I want to stress, if you're brand new to this, you are not going to get this kind of a win rate. You've got to practice. So we're green all. Yesterday we made $710 on the Russell 2000. We lost $200 on the ES. ES just was a stick in the mud. And there'll be times when you get in a trade and nothing happens. And you say, geez, hey, it's a momentum indicator. Nothing's happening. And then if you lose patience, everything says go, nothing's happening, you've got the right to take yourself out. And when that happens, don't be surprised that the thing moves. I'm real big about identifying when not to trade. That is huge, knowing when not to trade. All right. Still have TF displayed. Yeah, that's. I'm not showing the ES today. In the interest of time. All right. Now, the top pattern for profit, diagonal trend line break. I've shared that with you. 3. Yes, there are 4 other patterns I use and teach, but 50% of the trades are accomplished with the diagonal trend line break. You can take this, dissect it. Most of you are going to try to improve on it. You know, wonderful. No, as humans, we're never satisfied. Others are going to try it without paper trading, and they're going to lose money, and they're going to get so frustrated. Listen, this is a tough business. You owe it to yourself to practice. Don't worry about missing out on anything. Markets will always be there. Key point to remember, start drawing those trend lines at plus or minus 150. Better trades are in markets showing momentum. 20-period CCI for daily, weekly, and monthly charts, and any time period 60 minutes or higher. Some people watch, in Forex trading, a lot of people use a 4-hour chart. Okay, that means we use a 20-period CCI. 14-period for intraday below 60 minutes. Now, 512 tick chart, okay? I've used that for years. Great chart. 512 tick chart on Euro and on crude and on Russell 2000. So that would be 14. Now, entry rules. Diagonal trend line break with the trend. Remember, if you're new, the trend is your friend. Draw it from plus or minus 150 line. I use a confirmation price bar. And what that means is, since I'm using a 10 range bar chart, which is a fast chart, I'm not going to miss out anything if I get my signal and I just wait for one more bar to print. It confirms. So confirmation. Now, obviously, if it's a really, really, really strong trend, get aggressive. Go ahead. Counter trend trades are better suited for rejecting pivot only after you've mastered trend trading. Now, what you're going to find is there will be days when the trend trades just don't do anything. We get that. And all the winning trades are counter trend. Well, I don't care. In your testing, without risking money, you need to find out that stuff. All right. So let's just talk real quick about entry. So here we got diagonal trend line break. Right about here. Okay. So this would be like a confirmation bar and then go long. Each bar is a $100 range. So this right here, $300 before you can blink your eye. Over here, diagonal trend line break. In other words, it flipped back up, it broke that diagonal trend line on this green bar, and then we confirm with this bar, and up we go. Now, it's the same method on all of these diagonal trend line breaks. Let's talk about protective stop. This is the best thing I've ever found. and nothing's 100%, but this works extremely well. Place your stop below support if you're going to go long, or below trigger bar low on a daily chart. Place your stop above resistance if going short, or above a trigger bar high on the daily. But we're here talking about intraday. So need to modify this just a little bit. Place your stop, and I'll show you on the chart, don't worry about that. Place your stop below the trigger price, below the trigger price bar, I should say. If you're going to go long, place your stop below the trigger bar or the prior price bar to the trigger bar, whoever is lower. If you're going to go short, you place your stop above the trigger price bar, or what's that bar next to it? Is it higher? Then use that one. I'll show you what I mean. All right. So here we are, diagonal trend line break. This probably turned it. This is confirmation. Protective stop goes right here. Initial. Whoever's lower now. Let me find out who's lower. The green bar is actually lower. Okay. So it's going to, protective stop's going to be just below the green bar. What's just below mean? About 3 ticks. This is your initial. Obviously, you can move it up as price moves up. I've got my thing set where it will take a contract off at 10, that's $100, and it moves the protective stop up to break even. Some people, good traders I know, will take one off at 10 and move the protective stop. They will trail it minus 6 ticks because they know Russell 2000 can be whippy back and forth. And I'm talking about people that use multiple contracts rather than pinning their hope on a single contract. All right. What about this trade right here? Here was your, here's your signal. So we probably turned here, and this confirmed. And the protective stop will go right here. Just underneath it, about 3 ticks. Here's diagonal trend line break. Here and here. Protective stop always goes. Let's see, on this one it might have been, the protective stop might have been here. Okay. Now, when using a 10 range bar chart, the maximum, if I get in the worst possible entry, let's say I let the confirmation bar print. Okay. Trigger bar prints, and let's say that's 10. That's 10 ticks, okay? 10 ticks. Whoops. And then the confirmation bar prints. And that's 10 ticks. And I immediately enter. Typically it'll go against me a little, but then pans out. But sometimes in a fast market, the minute I hit to enter the order, If it's really fast, there's another 10 ticks before I can blink an eye. What I like about range bars is I always know the absolute maximum that I've got at risk. All right? That's what I like about range bars. It's always quantified. It is a mechanical exit. It's not anything like looking at a minute chart, let's say a 3-minute chart, and hey, in 3 minutes, you might have a $300 bar. This is like the maximum that we're going to be risking. And it's initial. Most of the time, it could be less. But that's what I like about range bars. We're telling price, hey, you prove it to me, you're moving. All right. So let's look at this one right here. Diagonal trendline break. Let's see where that is. Is that it? Looks like it. I think we actually got in. Okay, this is when we got in here. And protective stop should have initially been here. Okay, right here. But we saw it go up against us and elected to just get out early. We took a small loss on that. So remember, we're watching crude. It's in the middle of Janet Yellen's testimony. So, you know, you've got a right as a discretionary trader. So, boom, we did. If we'd have just left it alone, in hindsight, it's like, oh, but that worked. You don't know that in the heat of the battle. And then all of a sudden, look at this. We just go sideways. A lot of people probably got chopped up there. You had a signal. We didn't take it. There's your signal. Just go short. Not us. Because it wasn't finished chopping up. Here's one. Okay, here's a good one. See if I can get this right. Okay. So, we get into the trade, protective stop. If that's the trigger, protective stop is right up here. Previous bar. And you see how it works. You should really test this. If you're having problems with exits, test it. If you're going to try to trade the Russell 2000, forget about trying to use a 5, 6, or an 8 tick stop. Just forget it. Forget it. This thing will jump that in less than a second. All right. So what about exits? Well, I'm real partial to profit targets. And you decide the target. I always say entries are the easiest thing you can do. Exits are the most difficult. And the reason it's difficult is because it depends on everyone's attitude toward money. Some people, they look at every trade like the trade of the century. Other people look at every trade sweating. And I know a guy, his first takes, he uses 369, okay? That's his deal. Everybody is different. So profit targets, you decide. There for a while, I was using 3 contracts for the class and just taking one off at $50, and shoot, the win rate was astronomical. Right? Because the probability, when you got an instrument like Russell 2000, you get a signal, it's high probability you're going to make 5 ticks. Okay, so you can do profit targets, whatever you decide, whatever's comfortable. CCI starts turning back at the 150 line. This is where your first warning shot. Hey, we might be losing momentum. That's a warning shot. If the CCI crosses the 100 line, you know that's minor support and resistance. This is when you should actually be out of the trade. You can always get back in if you have a reason to get back in. If price touches the pivot, the machines typically want to reject the pivot. Well, we were in a trade today and we hit the pivot, and I said, I extended the profit target actually. And I said, I probably am going to get bid on this thing because the pivot is what they want to do. They want to reverse on the pivot. Sure enough, it reversed. It eventually went our way. But it's just, life is so much simpler when you just say, okay, I know what the machines want to do more often than not, and I'll just play by their rules. If price touches a channel line, and I showed you that, let's say you've got some kind of a channel line, okay, and price is just coming down, and you're going to go long, right? And you've seen this kind of action, right? Well, guess what? Chances are the next time it goes up, it wants to reject that line again. The line holds until it doesn't. Why not make that a profit target? Who cares if it goes higher? You're not sitting at the banquet table. You're picking up the crumbs. You can always use a runner if you think, hey, it might break out. That's your choice. But especially on counter trend trades, you should be very conservative. Now, what I've taught you today is robust across any instrument. I got to speed this up. Across any chart time frame, our method is if an action repeats, we can trade it. I use this 10 range bar. I've used 512 for years. I've used the volume charts before. Okay. I've settled on the 10 range bar. I told you why. And I prefer activity-based rather than just time charts. I will look at a 15-minute chart. Yes, I will look at it to make sure I know what's going on in the big picture. Momentum traders believe they're in for the long haul, taking a series of trades, converting to cash quickly. Runners are for longer-term moves. All right, put your hopes on the multiple contracts rather than a single contract. And paper trade. Understand your ego, your mind, and your attitude toward money is ruling you when you paper trade, or when you trade real money. This chart just says you need to practice. Just practice, okay? Takes a while. Block out your distractions. I lost a bunch of money when I was renovating a home, serving as a contractor. I've never done that before. Mr. Rhymes, we need this. Mr. Rhymes, we need that. Mr. Rhymes, we need that. Mr. Rhymes, can you look at this? Simple. Become as mechanical as possible. Forget about the experts, by golly. No, forget that. You become your own expert. Yes, you go and take webinars or coaching, whatever, to refine and shorten your learning curve. But the goal is you become the expert. Bottom line, simple system. I do keep an eye on the fundamentals. That's why our position trade in sugar worked so well. We knew the fundamentals. Perform your own due diligence. Forget about what they say on television. This is all I use right here. S&R, moving average, oscillator, and pivots. Okay, and 2 hours a day. When I do try to trade the afternoon, it's amazing. The market rewards me by saying, what are you doing? And everything just dries up. And then it's like, what am I? Okay? This is a money game. I'm almost finished. This is a money game. You must have money to make money. So even though your broker will allow you to trade a contract with $500 in margin, that's not what you want to do. You got to have money to make money. You've got to have a proven system that you can prove it on paper that it works. Then comes the challenge of trading using real money live. Forget about getting in on the cheap. So consider $5,000 minimum for trading one contract. The smaller your account, the more you will trade in fear of busting the account. Now, I don't have a problem if you have two accounts and one of them is a small account and you just use that one for, I don't know, research and development, or you use a smaller account just for because you can't help yourself. You know, I got a friend that he cannot walk by a casino without pulling in the parking lot. He has to. Okay. Goes in there and plays roulette, a couple trades, and goes away. I've seen the FedEx guy at the horse track before, right? Nobody knows he's there. He had to come in on one race. So, I mean, if that's your style, understand yourself. And isolate that play money. All right, now I read this book, The Trading Game by Ryan Jones, and I like it. It just speaks to me. So if you start out with 5,000, then you only add a contract when you've made 5,000. If you can't make $5,000 off one contract, then you're not ready to trade. It's going to take time, yes. Once you've made $5,000 in profit, then you add a contract, okay? If you lose $1,500, guess what? You drop back to one contract. That way you are taking contracts off faster than you're adding. Okay, you make another $5,000. Great. Add a contract. Now you got two contracts. You lose $3,000 on two contracts. Cut back. Okay? You're taking off faster than you're adding contracts. It's very simple. There's no reason to read a thick book on this stuff. There's no reason to look at models. Just keep it simple. Hey, if I make $5,000 on one contract, I'll add another. If I lose $1,500, I'll go back to one contract. Make $5,000. Well, now I got the $5,000 plus the other profits. Okay, now I got more in the money, more in the kitty. Shoot, I lost $3,000. Guess what? Cut back. And so forth. You add, every time you make $5,000, you add a contract. You lose $1,500, you need to cut back. I'm talking about $1,500 per contract. All right. Now, I'll take questions. I'm sorry, Josh, we're running late. I appreciate Trader Kingdom so much. Thank you, Ninja Trader. Kinetic Data, thank you. This Rooster Call is a good read. Every morning, okay, Monday through Friday, free for 30 days for you. It's just my opinion, trader perspective. Enjoy writing it for clients. Want to remind you, if you're interested in really getting into the nitty-gritty about day trading, a simple, easy way, nothing's 100%. And when I say simple and relaxed, yes, after you learn the system. At first, when you first learned how to tie your shoes, your brain did not know what was going on. It took you time to learn how to tie your shoes. So mark your calendar. This is a great course. If you want to do position trading more, swing trading, no problem. We're doing this next week. I will touch on day trading, but total immersion day trading is the just day trade, and the just day trade. Okay, are there any questions whatsoever? Any questions? I'll take any questions whatsoever. Any questions? What's this? Very well explained. Have no questions. Thank you for, okay, good. I want to stress everything I do, we work from the right edge of the chart. Question, are you using market orders to enter a trade? Yes. Let me tell you, in the afternoon last week, as soon as I entered the trade, immediately, Larry, immediately, $50 against me, immediately. And then I look and I see, my gosh, I'm practically the only person in here. The volume was just so absolutely pathetic last week in the afternoon. I think there was a couple days when it was phenomenal, but it had really, really dragged. It was like they were waiting. So the minute I entered, the absolute minute I entered, boom, $50, gone. But normally in a good market, you're going to be, you're going to get a slippage of a tick. Fast market, maybe 2 tick. That's fine. That's fine. It's fine for me. I'm not going to worry about that. Do I monitor time and sales for volume? No. No. No, no, no. No. Absolutely not. Absolutely not. I keep it so simple. For example, I'm always looking for a move in the 10 o'clock hour. In the 10 o'clock hour, I'm always looking for a move. I don't know when it's going to happen. It tends to happen at 10:08. But maybe tomorrow it's going to happen at 10:15. I don't know. But if I wanted to be the most conservative day trader, I would wait until 10 o'clock because we always get a move. Every single day there is a move during the 10 o'clock hour. And a lot of times the way we trade, we are ahead of the people who are doing watching the dome and watching this other things. And by the way, you cannot trust the dome. Not because of the chart package, is because you know that they are spoofing the orders. They want you to think there's orders out there. So I would rather let price be the final determinant. And remember, when these machines are coded to trade, once they get going, they are seeking out the next level of support and resistance. The reason that they get caught in these sideways markets, and by the way, hey, I got a no-go rule. If we're trading, I don't know, $200, $240, something like that, $260, I'm not interested to trade that. I wait for that to break out. But the machines are locked into watching how many price bars back did price have a certain average true range. And then the reason you get these sudden breakouts is because either somebody simply overloaded the boat and it busted through. Otherwise, these machines will trade this sideways, and I've seen entire days where we've been sideways. If you go back to the markets of 2004 and 2005, regression analysis trading was the big rage because the range was so incredibly small. So a mathematician friend of mine, he traded huge amounts of contracts. It goes to the top, he sells. It goes to the bottom, he buys. It goes to the top, he sells. It goes to the bottom. Not trying to make a lot of money, but it worked. Are the parameters for the CCI customized? I give all my clients a copy of my template. They're not customized. I give my template to help people. So, you know, the color coding I've got on there, yeah, that's customized. That's customized, definitely. But otherwise, no. I think the CCI standard comes up with a 0 line and a 100 line, maybe a 200 line. So I think I put the 150 line in there. Any other questions? I need to wrap this up for Josh. Any other questions? Okay, I want to share with you this rooster call for 30 days. You're going to enjoy it. I like writing it. Beyond that, I think you know enough about me now that you know you'll get a lot out of this boot camp or the day trading, the Just Day Trade. I waited a long time before I put that course together. Thank you, Bob. Appreciate that. Hope to see you in class. So we got the boot camp next week. And the following week, we've got the Just Day Trade. Okay? That's it. I want to wish everyone a good evening. I bid you a fond adieu. I'll talk to you later. Thank you, Josh.